Bismillahirrahmanirrahim. Let's start with the past paper question. That is the question of September 2020 attempt. There is a final account question, and let's start the question and let's see what adjustments are there and what is the requirement of this question. First of all, let's read out the question. Loudon Company has prepared a draft statement of profit or loss for the year ended 30th September 2008 before any adjustment required by note 1 to 4 below. The draft profit has been added to retained earning, and the summarized trial balance of Loudon Company as at 30th September 2008 is. So it means there is a trial balance, and there are few adjustments. That is from adjustment number 1, 2, 3, and 4. And these adjustments has not yet been accounted for in the profit and loss account. It means we need to adjust these adjustments, and we need to adjust the profit and loss account figure, or we need to adjust the profit figure. But the question is whether the unadjusted profit is given or not. So if you look at the trial balance, so we have certain account balances just like equity shares, retained earning, that is the 30th September 2008. It's a draft retained earning. It means it's not finalized, and it is clearly stated in the start of the question that few adjustments are required, and these adjustments are from A to B, that is from 1 to 4. And then office building, factories, office building accumulated depreciation, factories accumulated depreciation, environmental provision, current liabilities, current assets, proceeds of 5% loan notes, deferred tax interest paid, and then suspense account. Now, the question is there is no profit given right now in this question or in the trial balance. So it means it is also mentioned in the question the profit is transferred to the retained earning account. So whatever the adjustments is required, whatever the adjustment we'll make all those adjustments through retained earning account. So it is quite clear that profit or unadjusted profit is not given in the question. So we are going to make all those adjustments through retained earning account. So we are going to adjust basically the retained earning account. So what are those adjustments and how we are going to solve these adjustments? First adjustment, and one more thing, always remember, whenever you start the question of final account is not a separate topic, it's not a separate chapter, but it's a summary of all accounting standards. Definitely, when we are going to read out all those adjustments, we will going to find out that in those adjustments, we will be finding out the application of different standards, just like it may either be IAS 12, IFRS 9, IFRS 16, IAS 16. So in those adjustments, we are going to apply different standards. So it's a summary of all the standards. It means whenever you are solving the question of final account, it means you will be revising, you will be summarizing all those standards. So first, the strategy to solve the final account question is that always try to take adjustment. First, let's see what I will do. First adjustment, and then I'm going to solve that adjustment. I'm going to solve that adjustment, and then I will put on the values or the figures to the adjustment or to adjust the retained earning account. Let's see what is the first adjustment. Loan note. A 5% loan note was issued on 1st October 2007. Let's recall what is our year end. Let's see to the question. Get back to the question. Our year end is 30th September 2008. It means it's just talking about the start of the year. Okay. 1st October 2007, issued on 1st October 2007 at its face value of $5 million. Okay, now let's recall. A loan note was issued. Let's recall. I think it's IFRS 9. Okay, financial instrument. Let's recall there are two types: the financial asset and the financial liability. What we are talking about right now, we are not investing. We are not purchasing the shares, we are not purchasing the loan notes, but we are issuing the loan notes. It means it's not the financial asset side, but it's the financial liability. Now let's recall some other things, some other data. Financial liability. What does it mean? Financial liability means you will be having one option, that is the amortized cost. Okay, amortized cost. And number two, financial liability. Whenever we are doing a question of financial liability and it is with amortized cost, it means whatever we have a net proceeds, the initial direct cost or the issue cost or the transaction cost, is deducted from the proceed. That is the major difference between the financial asset and the financial liability. Remember, in financial asset, if it is from amortized cost, what we have done, we normally add up, or we normally capitalize that transaction cost in the investment amount. But in case of the financial liability, what we do, we deduct the transaction cost from the proceeds. So let's see what it is. Company issued a loan note of 5%. And what is the 5%? That is obviously the coupon rate. On 1st October 2007, at its fair value, that is the par value, and that is also the market value, that is the $5 million. Direct cost of issue amounted to 0.125 million and were charged to profit and loss. Hold on. Now what went on? 0.125 million, that is $125,000, is the amount that should have been deducted. That should have been deducted from where? That should have been deducted from the proceeds, that is the 5 million. But what the accountant has done, he has charged that amount to the profit and loss account, that is, it is expensed out. So let's see what actually went wrong. Let's try to practice out. If I just have a scratch pad, and what I say, okay, what should be the original entry? What should be the original entry for that 0.125 million? In my opinion, the original entry should have been the lease liability debit. By 125, okay, 125, and should have been credited with bank, that is 125. That should have been the original entry. This should be the original entry. But what accountant did? Let's see. What accountant did? Let's see. What accountant did? That is the error entry. What accountant did? Accountant basically made an entry like debited the P and L, or we can say that the retained earning, because profit and loss account or the net profit figure is not given in the question. So we are going to make all those adjustments through retained earning accounts. So debited the retained earning account, and what he did, credited the bank as usual. Now what adjustment is required? Basically, what adjustment is required? Now what adjustment is required if we make, or if we just correct this entry, correct this error, correct entry? What is gonna to be the correct entry? So the correct entry would have been that we are gonna to credited the lease liability and debited the lease liability with 125, as it was not debited as it should have been, and credit what? The P and L, or we can say that the retained earning credited by 125. That is the adjustment which is required. Okay, and if you are crediting the P&L or the retained earning account, it means we are increasing the profit or we are increasing the retained earning balance. So it means that is the adjustment which is required. Okay, now let's move on. Let's read out the full adjustment. Further, the loan will be redeemed in 5 years' time at a substantial premium, which gives effective interest rate of 8%, the annual repayment of 250. And that is obvious because we know that company pays some amount of interest to the investors, and that is basically the coupon rate at the par value. So if 5 million is the par value or the face value, then the 5% is 250 are paid on September each year. It means, remember, at the start of the question, it was clearly mentioned that these particular adjustment has not yet been accounted for in the net profit calculation or the retained earning calculation. It means we need to account for this one. So let's start with the adjustment, and First of all, let's read out the requirement of this question. What is the requirement of this question? There are certain adjustment, and the requirement is A. Prepare a schedule of adjustments required to the retained earning of LOUDON company at 30th September 2008 as a result of the information notes from 1 to 4. It means we need to make a summary or the statement that require adjustment. So balance sheet. It means we need to prepare the balance sheet as well. So let's start with the requirement one. We are going to adjust the retained earning account first of all. So what is the retained earning balance? Retained earning balance which is given, that is 4122. 4122, that is the retained earning balance, that is retained earnings as per trial balance, and that is obviously unadjusted. We need to adjust this balance. So retained earning as per trial balance, which is 4122. So now first adjustment which we are going to do, that is from IFRS 9, that is the loan notes. So first adjustment which is required, which we have made or which we have worked out, the scratch pad, that we need to adjust this $125,000, and that is to credit the retained earning account, because the accounting has incorrectly debited to the profit and loss account, which it should not be. So let's adjust the issue cost. Issue cost, that is 125, and we are going to add this one. Reason is we are going to increase the retained earning balance. Okay. So one more thing is that interest for this one has also not yet been accounted for. That is the finance cost. Finance cost with respect to that is also required to be adjusted. So let's make a table of this. That is the opening balance. Number 2, the effective rate. Number 3 is the coupon or the paid interest, and then the closing balance. So what is the opening balance? Opening balance of the loan note or the loan issue is that is where it is that is 5,000, and definitely we are going to deduct the amount of issue cost, that is 125. Is it? Because issue cost or the transaction costs are deducted from the proceeds. So proceeds were 5,000, and we deducted the issue cost, that is the transaction cost. Effective rate was 8%. Effective rate is 8%. So let's effective rate 8%, and coupon is 5%. Okay. So effective rate is 8%. That is 4875 multiplied by 8%. 8%, that is 390, and coupon amount is definitely the face value is 5,000, I guess. Yes, 5 million, that is 5,000, and the percentage is 5%. That is 250. The closing balance would be the 5015. We are not supposed to prepare the complete table for 3 years or the 5 years. Reason is that is for 5 years we are not supposed to prepare the complete table. Reason is we need to account for the 1 year interest, so it is quite sufficient that we make a table for just 1 year, that is for the year 1 only. Now what interest should be charged? That is the 390 interest should have been recorded, as it is not recorded, and if we are recording that interest, it means we are reducing the profit, or we can say that we are reducing the retained earning balance. So that is the finance cost with respect to loan notes. Finance cost of loan notes to be accounted for, and we can refer this for working one. So what is the amount? Let's link that amount with 390, but this should be deducted or eliminated. Okay. So another, let's move on. That was the first adjustment that we have accounted for. There is no further more adjustment, but yes, once we are going to prepare the balance sheet, we'll take this 5015 as the balance for non-current liability or the long-term liability with respect to loan note. Because remember, loan note initially we recognize as 4875, but subsequently in the balance sheet it will be recognized as through the amortized cost, that is 5015. Once we are going to prepare the balance sheet, inshallah, we will look that thing in that area. Okay, now let's move on to the next adjustment, that is with respect to the non-current asset. Okay, LOUDON company acquired office building of $20 million on 1st October 20x2 with an estimated useful life of 25 years. Depreciation is charged on a pro rata basis, that is proportionate basis, on 1st April 20x8. Hold on. That is from October to 30th September 20x3. That is the one accounting period. That is 20x3 September, x4, x5, x6, x7, and in the middle of the x8. Okay, it means 5 years and few months. On 1st April 20x8, the building was deemed to be impaired at its fair value was estimated to be $12 million. At that date, the estimated remaining life was revised to 12 years. That means afterwards, the remaining life was 12 years. Ignore the deferred tax consequences of this revaluation. Okay, let's ignore the deferred tax for these purposes. And again, another thing is now another asset. LOUDON company had 10 factories. On 1st October 2007, LOUDON company sold one of its factories. Now there are two assets. One, initially they discussed about the office building, and now they're discussing the factories. So we are going to make, or we are going to work out both the adjustments in a different way, in a separate way. We're not going to mix both the adjustment, otherwise it would be too complicated. So let's do with the office building first. Let's go with the office building first, and then we are going to solve the adjustment for the factories. So office building. Let's work out for the office building, that is working to, that is office building. Let's work out each and everything for this, and then we'll work out for the factories. So office building. So what it is saying, company acquired office building for $20 million, and on 1st October 20x2 with an estimated useful life 25 years. It means on 1st October it was acquired. So it means on 30th of September, 20x3, and then further if we're going to move on, 30th of September x4, September x5, and when the adjustment is, that is 30th of March, sorry. Okay, so it means we need to calculate depreciation, because that is the adjustment from IAS 38, that is impairment, and the asset is impaired on 1st April 20x8. It means the asset is impaired, so it means we need to calculate the impairment loss of it. And how do we calculate the impairment loss? That is to compare the carrying amount with the recoverable amount. What is that recoverable amount? Is the higher of fair value less cost to sale, and the value present value in use. So we are going to compare these things, but the best part of this question or this adjustment, that it is already given, that is the fair value, that is the higher value, or the recoverable amount is already given, that is the 12 million. So we need to calculate the carrying amount of that asset till 1st of April 20x8. So and what is the depreciation formula? That is straight line method. 20 million, it means 20,000 divided by 25. It means the depreciation for 1 year is 800 and that will be same for all accounting period, that is 2007. But for 30th March, let's count October, November, December, January, February and March. It is that is 6 months. So it means 800 multiply by 6 and divided by 12, that is for half year, that is 400. It means the depreciation till 1st of April is the sum. Let's make the sum of it. So that is 4,400. That is the accumulated depreciation. That is the accumulated depreciation till the date of impairment. Let's calculate the book value or the carrying amount. Carrying amount would be the cost. The cost of the asset was 20,000. 20,000 minus 4,500. That is the accumulated depreciation. And what is the recoverable amount? That is the 12 million. That is 12,000. It means the impairment loss would be 3,600. That is the impairment, and that needs to be adjusted. That needs to be adjusted. Impairment loss. So impairment loss is 3,600. So that is the impairment loss that need to be accounted for. And if we prepare the entry for this, what entry normally we do prepare for the impairment loss is that P&L debit, and asset credit. And we are not working on the P&L side, but we are working on the retained earning account. So retained earning would be debited. So let's debit the retained earning. Let's debit, and if we are debiting the retained earning account, it means we are reducing the balance of retained earning. So impairment loss, refer that one for working too. So minus 3,600. 3,600, that will reduce the impairment retained balance of retained earnings. So, but one more adjustment is required there. One more adjustment is required that for the year ended. One more thing is that let's continue with that. That was the office building, and we just recorded the impairment of office building. Let's move on. Another part, LOUDON company had 10 factories. Now let's work out on the factory side. On 1st October 2007, LOUDON company sold one of its factories with a carrying amount of $3 million. That was the book value, and cost was $5 million, and accumulated depreciation obviously $2 million for $3.5 million. That asset was sold for $3.5 million. But what happened? The proceeds were credited to the suspense account. Oh, great. What happened? What happened so far? Let's read out the full adjustment. No depreciation has yet been charged on any non-current asset for the year ended 30th September 2008. The factories are depreciated 15% using reducing balance method. What does it mean? It means the depreciation of this building has not yet been recorded. So first of all, let's record the depreciation. The depreciation for 6 months, that is for first 6 months, is 400. And after impairment, the depreciation for next 6 months, the depreciation from April till September, definitely the further depreciation will be charged on the recoverable amount, that is 12,000 over its remaining useful life, and that was 12, that is 1,000. But the thing is, the depreciation for 6 months should be charged, that is multiplied by 6 and divided by 12. So it means the depreciation till April, from April to September would be $500. That would be $500. It means the first 6 months depreciation is 400, and the next 6 months depreciation is 500. It means depreciation of office building. Depreciation, let's summarize this one. For office building is 500 plus 400 for the first 6 months. That means 900 of depreciation should also be charged or debited to the retained earning account. We'll do it, but first of all, let's make an adjustment. For the factories. Let's go for working 3. That is for factories. Factories. Now, what they're saying about the factories? They have sold the factory, one of the factory, for 3.5 million. But what they did, the proceeds were credited to the suspense account. It means there should be a suspense account balance in the trial balance. Yes, it is. There is a balance of 3,500. That means 3.5 million balance is there in the suspense account. So let's see what actually the entry should have been and what they have done, or what they have made the error. Let's have a look on it. If they have sold the asset, that means the entry should have been bank debit, and definitely Definitely, if bank is debited, asset will be credited, and if there's a gain, so gain should also be credited. Asset, or we can say that factory and gain. This should have been recorded. Let's see what they did. Bank, they have sold the asset or the factory for 3.5 million. That means for 3,500 it should have been debited. Factory is sold out, that is a carrying amount. Carrying amount of that factory was 3 million. It means factory should have been credited with 3,000, and further the 500 of gain should have been recorded. That was the original entry, or that was the correct entry that should have been recorded. But what they did, I guess, from this adjustment, it seems that they have debited the bank. But what they're saying, the proceeds were credited to the suspense accounts. Proceeds were recorded, but what they credited the suspense account. It means neither the gain nor the factory is removed from the account. It means suspense account is credited. Therefore, there is a balance of suspense account, a credit balance of suspense account with 3.5 million. So they have made this error. Now let's rectify. There is no rectification required in the bank side, but yes, the suspense account should have been removed. So let's debit the suspense account. Let's debit the suspense account. We debited the suspense account with 3,500. Let's credit what we are going to credit the factory as it is not credited yet. So 3,000, and let's credit the gain on disposal. Gain on disposal with the amount of 500. So that is the original entry that should have been recorded, that should have been adjusted, that should have been accounted for, but it is unfortunately not yet accounted for. So let's account for this one. But specifically, if you talk about the profit or the retained earnings side, what account will hit the retained earning? Suspense account? No, it will be nullified once we are going to prepare the adjusted trial balance or the financial statement. Number two, factory, it would affect the balance sheet side definitely, and the gain should also be recorded, and it should be recorded like we are recording the gain on disposal. So let's add up the profit or the retained earning balance. Gain on disposal, and the amount was 500. Let's link that amount, gain. So gain on disposal will also be recorded. Let's refer working three. One more thing, we have calculated depreciation for office building for the year, and that should have been accounted for. And we need to calculate the depreciation for factories as well. Depreciation for factory, and if that asset is disposed of in the middle of the year, it means that depreciation for half year is required. Otherwise, if it is disposed of at the start of the year, no depreciation will be required, because depreciation is calculated on a pro rata basis. And if it is disposed of at the end of the year, it means full depreciation of factory will be required of the disposed asset. The asset was disposed, had 10 factories on 1st October 2007. It means it was disposed at the start of the year. It means no depreciation of the disposed factory is required. So what are we going to do? We are going to eliminate or deduct that asset while calculating the depreciation. The cost of the factory is given in the trial balance. Factory's cost is 40,000. Cost of the factory is 40,000, but we are going to deduct the disposed asset cost that is already given in the question, that is 5,000. So the cost of remaining asset is 35,000. Remember, there is a reducing balance method. So the formula for the reducing balance method is the cost minus accumulated depreciation. And accumulated depreciation is also required. The accumulated depreciation for the factories is given in the question, that is 11,100, and we are supposed to deduct the accumulated depreciation, that is 2,000, and the remaining accumulated depreciation is 9,100, and the depreciation for the year is remaining cost minus remaining accumulated depreciation bracket open. That is the remaining cost minus remaining accumulated depreciation, bracket close, multiply by rate of depreciation is 15%, 15% per annum. So that is the depreciation for the year for factories, and the total depreciation for the year, total depreciation for the year of non-current asset, total depreciation for the year of non-current asset is depreciation for office building is 900, and depreciation for factories is 3885, that is 4785 is the total depreciation. So total depreciation is 4785. Okay, so 4785 is the depreciation of non-current asset, and definitely we are going to do less this one as it will reduce the retained earning balance. So 4785, we are going to reduce the retained earning balance by 4785. So that was the complete adjustment of point 2, that is the non-current asset, which we have done. Impairment was recorded for office building, gain on disposal was adjusted, and finally the depreciation for non-current asset is also recorded. Let's move on to the third adjustment, that is the environmental provision, that is IS 37. Definitely, LOUDON company has an obligation to clean up environmental damage caused at one of its factory site during 20x7. The cleanup is due to take place at the end of the factory's useful life. The liability has been accounted for appropriately, and the balance at 1st October 20x7. Let's see, is there any liability recorded for environmental provision? Yes, environmental provision on 1st October, liability is recorded for 1228. Represents the correct present value, that is the present value. And remember, environmental provision is recorded at the present value, no doubt it is recorded at the present value. And number 2, whenever the liabilities are recorded at the present value, what is the next process or is the next step, that we are going to unwind the liability at each accounting period. We are going to unwind the accounting liability for each accounting period. So it means we need to unwind this one. We need to unwind this present value liability. So that is LOUDON company had a cost of capital of 5%. It means we need to unwind this one. Liability present value is already recorded at 1st October and the whole accounting period has been passed. So it means at the end of the accounting period, we need to account for the unwinding of this one. So what is the present value of the liability? Present value of the environmental provision is 1228, and 5% is the cost of capital. So 1228 and multiply by, that is 5%. 5%, that is 61.4 is the unwinding environmental provision. Definitely, there is another impact on the balance sheet side. The liability will also be increased by 61.4. So that was the very short adjustment for environmental provision that was required. Now the last one is deferred tax, that is definitely IS 12 at 30th September 20x8. The tax written down value of property, plant and equipment was $25 million. That is the tax base given in the question, and the income tax rate applicable is 20%. That is the tax rate given. Now deferred tax is required to be recorded. Deferred tax need to be recorded, and the deferred tax balance is also given in the question, that is 1500, that is the opening balance. And the tax base is given for the property, plant and equipment. Now let's recall the trial balance. Is there any property, plant and equipment? Basically, the tax base is given for all non-current assets, and we have two non-current assets, that is the office building and the factories. So it means we need to calculate the carrying amount of both the non-current assets. So let's calculate. We have already worked out each and everything. So we just need to compile all the data for non-current asset, that is deferred tax adjustment is required, and we need to calculate the carrying amount of non-current asset. Tax base is already given. Once we are able to calculate the carrying amount of all non-current asset, it means we are going to easily calculate the deferred tax. So let's have a look on it. Carrying amount of non-current asset. That is, first of all, let's have a look on the office building side. Office building. What is the carrying amount of office building? Remember, we have made an impairment, or we have recorded impairment loss, and the recoverable amount of the office building was 12,000. Remember, that is the 12,000 is the recoverable amount. So it means recoverable amount, and after that we have calculated the depreciation of 500. It means the carrying amount of office building, the carrying amount of office building should have been 12,000 minus 500. Is it? That is, the carrying amount was 12,000, as that was the original value, or the recoverable amount is the actual value of the office building, and we calculate further depreciation of 6 months. It means 500. That means 12,000 minus 500. It means if we just have a carrying amount of office building, that is 12,000 minus 500. It means that is the carrying amount of office building. Now let's calculate, or let's find out the carrying amount of factory. Factories. How we are going to calculate the carrying amount of factories? Let's have a look on it. We have calculated the depreciation for factories. Yes, the cost was 35,000 and 35,000 after the disposal. 35,000 minus, or we can refer this here as well. 35,000 minus the accumulated depreciation 9,100, and further depreciation for the year is 3,885. It means 22,015 is the carrying amount of factories. It means total carrying amount for non-current asset is, let's sum up these two, that is 33,515. That is the total carrying amount of non-current assets. Now let's see the tax base. Tax base is that is given in the question. The tax base is 25 million, that is 25,000. And carrying amount of carrying amount of an asset is greater than the tax base. It means the difference is taxable temporary difference, that is TTD, and deduct this one. So it means it's a taxable temporary difference of 8,515. But remember, that is not the deferred tax. Tax rate is 20%. Tax rate is 20%. So the deferred tax is deferred tax closing balance. Remember, always remember the percentage we are calculating on taxable temporary difference is the closing balance. Is the closing balance of deferred tax liability. The deferred tax liability closing balance is 1703. And what is the opening balance? Opening balance, that is given in the trial balance. Opening balance for deferred tax liability, DDL. The opening balance which is given in the question in the trial balance, basically the deferred tax liability opening balance is 1,500. So the difference is the deferred tax expense. Deferred tax expense for the year that should have been charged to P&L is 203, and that is the amount which actually should be recorded in PNL, or should be adjusted in the profit figure or in the retained earning amount. So deferred tax. So deferred tax adjustment is also required, and we have done it. Is there any other adjustment? No further adjustment is given in the question. So it means that was the full question, and let's find out the adjusted. Let's find out the adjusted retained earning balance and adjusted retained earning loss. Retained earning loss. Retained earning loss is 4292.4. That is the adjusted retained earning loss. So that is the adjusted retained earning loss. And now that was the first requirement of the question. That was the first requirement of the question. That is the statement of adjustment in retained earning. So that was the first requirement, and the another requirement is to prepare the balance sheet. Let's prepare the balance sheet. Prepare the balance sheet. That is the statement of financial position. Statement of financial position. Statement of financial position. First of all, let's have a non-current asset, and the best part is we have already calculated each and everything, and no further efforts are required to calculate the balance of non-current asset. We have two non-current assets. That is the office building. We are just going to link that cells, office buildings and factories. Office building amount, office building, carrying amount of the office building which we have calculated for deferred tax calculation, that is 11,500. And for factories, the carrying amount of factories is 22015. So that is the office building and factories. Total non-current assets that is 33515. Is there any current assets? So let's see. Is there any current assets? Current assets given the question? Yes, sir. It is directly given, that is 14,700. 14,000 is 700 is the total current assets. That is the total current assets already given in the question. So the total assets would be 48215. That is the total assets. Now let's move on to the equity side. Equity, share capital, that is always that will always be there in the question. Share capital, the equity, that is the first line item, that is $10,000. What else? Retained earning, and retained earning adjusted balance we have calculated. Retained earnings adjusted balance we have calculated, that is $4292.4 million. Okay. Another thing is there any reserves, revaluation surplus? No, there is no such thing. So let's sum up. So shareholders equity is 5707.6. Liabilities, let's work on the liabilities side. Liabilities, non-current liabilities or long-term liabilities, we can say that. Is there any long-term liabilities? Let's see. If you look at the trial balance, environmental provision, environmental provision. But remember, environmental provision which is given the trial balance is the present value, and we have made discounting, or we have unwinded that present value of environmental provision, that is 1228 plus 1228 plus, and the amount of environmental provision was this one, 5, that was 61.4, 1289.4. So that is the environmental provision. And is there any other non-current liability? That is the loan notes. Loan notes, and loan note figure that should have been reported in the balance sheet. We have already calculated, and we have made a table, a short table for that. That is 5015. That is the loan note. And is there any other liability? Yes, deferred tax liability. Deferred tax liability. And what is the deferred tax liability closing balance? We have already calculated. The deferred tax liability closing balance is 1703, and that should have been reported in the balance sheet. Further, is there any liability interest paid? That is expense? No further liabilities are there. It means all these non-current liabilities. So non-current liabilities are 8007.4. So that is the long-term liabilities. And current liabilities is already given in the question. That is 34,500. So that is the current liabilities, 34,500. Any other liability which is outstanding over there, or we just forgetting anything? No. Environmental provision we have added up. Okay. Deferred tax liability. Okay. No further adjustments. No further adjustments are to be accounted for. So the total liabilities is this plus this one. So that is the total liabilities. And if we just have a total equity, if you just have a balance of total equity, that means the total liabilities plus shareholders equity, that is 48215, and the balance of total asset was also 48215. So that was the balance sheet of this question. Definitely the final account question takes time, but once you practice it again and again, you practice different questions on Excel or on the workspace that has been provided by ACCA. Inshallah, you will have a very good, or the very strong side. That is going to be the very strong side for you guys. So best of luck for your papers. Thank you so much.